There's very few things that I dislike more than paying my tax bill, but I will tell you that there is one thing that tops even that, and it's getting a surprise tax bill. Now, if you're a business owner out there, if you're an athlete out there, if you're self-employed out there, chances are you've probably run into the same situation. Hey, good news, you made more money than we thought. Bad news, you owe more in taxes than we thought. It's a little bit of a double-edged sword. And in today's video, I'm gonna walk through something called estimated taxes. So you are never in that same surprise situation again, and you can get control of your tax bill and keep your money working for you longer than giving it to the IRS. Hey everyone, if we haven't met before, my name is Jacob Turner. I'm the co-founder of Moment Private Wealth, a financial planning firm that specifically helps professional and NIL athletes and business owners. In today's video, I'm gonna walk through everything you need to know about estimated taxes. And by the end of this video, you're not only gonna be confident about what your tax bill is gonna be, you're gonna know that you're never gonna have surprises come April 15th. So let's dive in. Today's video is gonna be all about something called estimated taxes. And I wanna frame up the conversation like this. If you are a W-2 employee, you are typically getting taxes withheld from your paycheck. If you are a business owner, you are probably making a salary from your business, which is a W-2, and then you're also gonna get distributions from additional earnings on top of that. That money, that distributions, is not gonna be taxed when it comes to you. So this video is gonna be really important for you. If you're an NIL or rev share athlete out there, chances are you're not getting any money withheld from any of the money you're getting from the collective or the school. So this video is gonna be really helpful for you. If you're a professional athlete out there, you're getting a W-2 paycheck from your team, but all that money that you're earning off the field, signing trading cards for the Nike deal you have, the Adidas deal you have, that money is not getting taxed today. So this video is gonna be for you. In this video, what we are talking about and what we're gonna walk through is a specific situation with real numbers to be able to outline this specific issue that I see happen time and time again. We get to April 15th, the tax filing deadline, and we have this surprise tax bill. And I assure you, if you watch this video, you're not gonna be in that same situation again. So let's take a look at some real numbers here. What you guys are looking at is, I put together a outline very simply to show if you made $500,000 the previous year, and you made $1 million this current year. How does this break down? How do you know how much to pay in taxes? And what we're just showing is for a single individual. So I'm gonna walk through all the numbers on this page. On the left-hand side, we're looking exactly at what somebody made previous year, $500,000. Salary of $150,000 and additional income of $350,000. Now, just like I talked about as an athlete, that could be off the field money. As a business owner, that could be distributions or additional profits from your business. Your total federal tax bill on that amount is about $150,435. Now, some of that money got withheld from your paycheck, but the other money, the distributions or that additional income, did not have money typically withheld from it. Fast forward to this year, you're saying, I'm having an incredible year. Your business is doing really well. You're making a bunch of money off the field. Your salary is still the same. You're making $150,000, but you had $850,000 in off the field money or distributions from your business. And you can see the estimated federal tax is $351,000. So what's gonna happen is this. You are gonna get money withheld from your paycheck in the amount of $150,000 of salary, and then you're gonna get taxes withheld from that. The other $850,000, typically there's not gonna be taxes withheld from that. And what we don't want to have happen is us to have some sort of surprise tax bill. So this is where estimated payments come into play. They act in a form of two different ways. One, it allows us to avoid penalties and interest from the IRS. And two, it makes sure that we understand what we're going to be owing, even if we don't have to pay it today. So if we take a look at the right-hand side of this page, we can see what's called safe harbor estimates. It sounds like a complicated term. I promise it's not. All safe harbor means is how much money do we have to pay in to make sure we avoid step one, interest and penalties, because we don't want to be having interest and penalties to the IRS. And you can see we really have two options here. We can either pay 110% of our previous year tax bill. So if you look back on the left-hand side, our previous year tax bill is about $150,000. 110% of that is $165,000. Or we can pay in 90% of our current year tax estimate. We are estimating that we're going to pay $351,000 in federal taxes this year, so 90% of that is $316,000. So you might be thinking, okay, how do I decide which one of these to pay in? Well, what I would tell you is we want to pay the IRS the least amount of money possible, and we want to keep the other money for ourselves. So typically for most folks that we work with that are continuing to increase their income, my recommendation is we pay in 110% of the previous year. And that's exactly what we're going to do in this example. So we want to make sure that by the end of the year, we've paid in $165,000 at least to avoid interest and penalties. And here's how this breaks down. Quarter one, our salary withholding, this is coming from the $150,000 salary, we're estimating at about $10,000. And we're saying we're going to make an estimated tax payment of $32,000 on top of that. Quarter two, the exact same thing. Quarter three, the exact same thing. Quarter four, the exact same thing. So where does that leave us? That leaves us in this exact situation. Our total estimated tax paid so far for the year is $168,000. So why is that important? Well, that number is higher than the 110% previous year of $165,000. So we have achieved step one. We are going to avoid any interest and penalties. Now, that's the good news. The bad news is we are still going to owe tax above and beyond the $168,000 that we've already paid in. And this is where I think it gets really, really important for everybody out there listening to understand. Just because you've paid in estimated taxes does not mean you're not going to owe additional taxes come April 15th. In fact, if you have a growing business, if you have a growing career, and you're making more money year over year, chances are you're always going to owe a little bit more money come April 15th. So now how do we navigate that? In this scenario, we owe about $183,000 in additional taxes on top of the 168. How did I get to that number? If you take 183 and you add it to 168, that gets you to $351,000, which you can see in the middle column there is our current year estimated federal tax payment. So what are we doing with that $183,000? Well, step one is we need to be planning for it and we need to be setting it aside. What we do at Moen Private Wealth is we typically recommend clients have a tax holding account where we're putting that money into throughout the course of the year. The reason why this is valuable is twofold. One, it achieves peace of mind. Remember what I talked about in this video? The only thing worse than paying taxes is having a surprise tax bill. And that's exactly what we want to try to avoid. The second facet of that is that $183,000, what we can do with that is we can put that in an interest-bearing account where we're not taking on risk with it, but we are earning some rate of return. Right now, the risk-free rate is hovering around 4%. So on our $183,000, that would allow us to earn about $611 per month in extra interest if we keep that money instead of paying it to the IRS in advance. So what you're understanding here is two things. One, by paying estimated taxes, we avoid any sort of interest and penalties for the IRS, even though we're going to owe the money in the future. But secondarily, and what I would argue is actually more important, is we make sure that we have the peace of mind that we know for sure we're not going to be in a situation come April 15th where we have a surprise tax bill and your CPA or your financial planner is coming to you and saying, hey, good news, you made more money than you thought. Bad news, you're going to owe a couple $100,000 more in taxes. And I would say the other cherry on top of this is that money, that extra $183,000 that we just talked about, we're able to earn interest on that and keep that money for a little bit longer. And like I said, in this scenario, based on the risk-free rate right now, you're earning about $611 per month on that $183,000 that you get to keep for right now, and you are going to have to pay to the IRS in the future. But this is exactly what we do with clients. Every single quarter, we're mapping out what their tax situation looks like, what they've paid in estimated taxes, what they're going to be paying in future taxes, so then they know they're going to have the peace of mind and we're never going to be in a situation where we have that surprise tax bill. As always, my goal is to help you get smarter with your money. So if you like that sort of thing, make sure you like and subscribe, and I look forward to seeing you on a future video. Until next time, my friends.